Welcome to The Explainer. In a market this complicated, you gotta ask, what separates the pros from everyone else? Well, it's their playbook. And today, we're not just gonna look at the market, we're gonna break down that very playbook, see exactly what they're worried about, and more importantly, where they're still finding opportunities.
This right here, this single idea says everything about the market right now. See, the thing to get is that fear hasn't vanished, not at all. It's just moved. Just a few weeks ago, everyone was terrified of an energy crisis. Today, that fear has been totally replaced by something new.
And that leads us to the market's split personality. On the surface, things look great. We're seeing an amazing rally. But man, if you look just beneath that shiny surface, there is a ton of tension building up.
I mean, the good news has been really good. Tech stocks have been on an absolute tear. You've got the Nasdaq surging almost 2%, logging one of its best winning streaks in years. And get this, the S&P 500 was just a dozen points away from its all-time high. It felt like pure, unfiltered optimism. But on the very same day, this was happening. Oil prices completely fell off a cliff, down over 7%. Now, let me tell you, when you see a tech rally that strong happening at the exact same time as an oil crash this bad, that is a massive red flag. It's our first big clue that this market is telling two very different stories at once. So let's break down these two competing narratives. On one hand, you have the good stuff. Inflation numbers came in cooler than anyone expected, and we got some positive chatter from ceasefire talks. That's what was fueling that big rally. But on the other side, the pros are laser-focused on the worries. You have that wild volatility in the energy market and, maybe more importantly, some shaky bank earnings, with Wells Fargo's miss hinting at some real trouble ahead. Okay, so this brings us to the real battlegrounds. Let's dig into the three hidden traps that professional investors are watching like a hawk right now. So here's what you really need to know about these three threats. First off, those ceasefire talks, they're incredibly fragile. If they fall apart, you can bet on an immediate energy shock. Second, the market is flying at a really dangerous altitude. When the S&P is this close to its all-time high, the risk of everyone deciding to take profits at the same time is, well, it's huge. And third, you can't ignore the weakness in the banking sector. That Wells Fargo miss could be the canary in the coal mine, signaling that these high interest rates are finally starting to put a real strain on the financial system. But here's the interesting part. Despite all those risks, smart money isn't just running for the hills and hiding in cash. So where are they finding the real buying signals? Let's take a look. What's really fascinating here is just how specific these plays are. The pros are totally ignoring the broad market noise and are zooming in on these key themes. They're looking at enterprise AI companies like Palantir and Salesforce, which are just perfectly positioned to ride this massive wave of AI spending. On the hardware side, they're watching advanced CPUs from companies like AMD, which keeps gaining ground in data centers. And then you've got this bigger strategic play. Amazon moving into satellite infrastructure, trying to build out its entire ecosystem, and of course, the classics. Gold and silver are still a key part of the playbook as a hedge against all that risk we just talked about. Okay, so we've laid out the risks and we've laid out the opportunities. How do the pros put all of this together into one coherent playbook? What is the actual next move? So you look at the VIX, right? The market's so-called fear index. And right now, it's low. And Textbook Investing 101 says when fear is low, it's time to buy. The temptation to just jump right in is enormous. But the professional mindset here, it's a completely different story. And this is the critical takeaway. A VIX below 20 is not a green light. Think of it as a blinking yellow light. It's a signal to take a hard look at what you already own, not to blindly add more. It means complacency might be setting in, and that is exactly when you need to be at your most disciplined. So here's what that action plan looks like in practice. Number 1, scrutinize, don't just add. You need to analyze the positions you have instead of just chasing the rally. Second, maintain your hedges. That protection against an energy shock is still absolutely vital. Third, hold onto your core long-term positions. Don't let these crazy short-term headlines shake you out of a good long-term plan. And finally, and maybe most importantly, avoid making emotional decisions. You have to resist that fear of missing out, that those all-time high headlines are practically designed to trigger. And that really brings us to the core tension driving everything in the market going forward. It's all balancing on these two huge forces. On one side, you have the fragile hope for geopolitical peace, and on the other, you have the very real, tangible promise of AI's return on investment. So the question for all of us is, which one of these do you think is going to break first and dictate the next big move?